making this research report. So the first step is company analysis, right? Understanding what the company is, who they are, what they do. And the first step of company analysis is understanding the business model. Now, traditionally, we've had very different types of business models, and now we are coming up with much more uh, newer types, right? So, for example, before we used to have manufacturers, distributors, the more traditional businesses. Now we have e-commerce platforms, one to many, many to many. So you have places like Uber, Airbnb, WhatsApp, Facebook. So this is a very interesting area, right? And how do you go about understanding? Well, the number one thing would be to understand what product or service the the firm is selling, right? What is the firm selling? Who do they sell to? So who are the customers? Or maybe you can group the customers into different groups. How do they reach these customers? How do they sell to them? Is it online? Is it traditional? How do they decide what to charge, right? For example, Uber has that dynamic charging algorithm, right? That depending on the demand. And then who does the company rely on, right? So you've got your captains, I believe, or drivers, or when it comes to Uber and Kareem, you have and the providers of cars that could be different from the drivers. Then, for example, in something like Airbnb, you have your people who put their extra rooms available on Airbnb. So you have so many different types of business models now, and then they have their very interesting ecosystems. So this is your starting point. And most likely, if you will be working on a research report in future, it's probably going to be for something which is a new type of business model, right? Because then it's worth writing the report on. I mean, the traditional businesses are probably already covered and invested into, and not much upside in their prices. So most likely you will be dealing with the newer businesses, and it's going to be interesting to understand their business model and how they make money. Now, how do you go about doing this, right? Where do you get the information from? So the information could be coming from the company itself. It could be coming from a third party, right? Or it could be your own proprietary. So I hope my spelling of proprietary is correct. And within third party, it could be free or it could be paid, right? So we're going to get into these three types of research and sources of information and sources of research, starting with the issuer. Now, how does the issuer tell things to you? They, of course, have their financial reports, both annual and quarterly. The annual one will have a lot more detail. Then they also have something called analyst briefings or conference calls, right? So you have analyst briefings, conference calls that they hold with the analysts to tell them, to explain to them whatever is going on in their business, the details that they would like to share. They could even make a presentation. And usually what we see is that the presentation which is discussed on the conference call is the one which is uploaded. Sometimes you have different presentations as well. You have to go to the investor relations web page on their website, and you can get those presentations from there. There are press releases, and by the way, all this information is not just on the customer and on the issuer's website. You will also find it on the stock exchange website, where their securities are listed. So that's where you can get a lot of information from as well. But the most convenient one is just go to the investor relations page on their website. And what also happens is, and I remember when I was an equity research analyst, we could call the the company as well, and we could ask their management or maybe their employees in the finance department about some details. And this is something you'll learn to appreciate as we go down this reading further in this reading, when we talk about working capital and fixed capital, that if I'm making a projection for a business, right, I need to know that, okay, if your sales grows, then will you need more money to invest in inventory, right? Will you need to have a bigger inventory pile, or will you need to give more credit to your customers? So is your account receivable going to go up, or are you going to need more property, plant, or equipment? So is your fixed capital need going to go up? And if yes, then where are you going to finance them from, right? Are you going to take on more loans? Are you going to issue new stock? So these are things that they might not have covered in their financial reports or in their conference call or analyst briefing. So then you need to ask them. Sometimes they tell you, sometimes they don't tell you, right? But what you really have to keep in mind over here is that there is a lot of ethical consideration that needs to be done over here, because if they are giving you information which is non-public, right, and this ties in with your ethics material, and if you've still not covered it, let me tell you, this is extremely important, that if you have access to information which is material. Now, what is material? That is something which an economic user would want to know, right? An investor or a lender or anybody who has an economic interest in this firm would like to know that piece of information. And if it is non-public, which means not everybody knows, but you know because you found out, then there is some very, very strict method at which you have to deal with that piece of information, right? And you need to refer to the ethics material for that how do you go about dealing with non-public material information. So I will leave that for the ethics part, but you do need to realize that in terms of your issuer sources, if you are getting information not through the financial reports which are public, or the analyst briefings and the presentations which are also public, or the press releases which are also public, but if you are directly getting them from the management of the company or the employees of the company, then that means the information is not public, it's non-public, and it very well could be material. So you need to take your ethics material into account and deal with that information accordingly. Right. Now, moving to third party. So this is not the company, this is third party. News, because we're talking about public third party, which is free, right? So all of this is free. Paid is coming up next. So this is your third party, which is free. Your general news, newspapers, television, other sources, search engines, right? All your free third party sources. And then of course you have your paid third party sources. Let me just go back to the free ones, and let me tell you the ones I used to really use, or I still use, by the way. So data.worldbank.org, I believe that's the website for the World Bank database. And then of course IMF data mapper. So these are very, very useful, right? IMF data mapper, World Bank, data.worldbank.org, I believe that's the World Bank database website. So they are free third party. And then paid third party, so like Bloomberg, FactSec. I remember I used to use something called Euromonitor. That's paid, right? That's interesting. And yeah, so you've got all these different providers of research and information. And then, of course, you bring it all together, and this is your value addition, your proprietary research, right? Whatever research you can do, surveys, conversations, product comparisons, other studies done by you, the analyst. So this is your value addition. So, yeah, so those are how you go about doing your first step. And then, now that you understand the business model, right, you can start at the very top and say, okay, what's the sales going to be? Because first you have to do the income statement projection. And the income statement, as you know, starts with revenue or sales, right? So that's the first thing you need to understand before you can move into cost of goods sold. And then you can understand the company's gross profit. And then you'll need to understand the selling, general and administrative expenses, right? And then you can come to the earning before interest and tax, which we also call operating profit, and then interest, and then tax, right? and then net income. So first of all, you need to figure out the revenue. And then accordingly, you can complete your income statement. And once your income statement is done, then based on the working capital needs of the business, that okay, if the sales is growing, will they need more investment in inventory? Will they need more investment in accounts receivable, right? Will they be able to pull some money from their suppliers? So is the accounts payable also going to increase? So what is going to be the net impact in working capital? Will they need more property, plant, and equipment, right? So fixed capital needs. And where will they get that money from? Are they going to issue debt? Are they going to issue equity? Then you will know your balance sheet, and then finally you would be able to do the cash flow statement. And based on that, you know the future cash flows, and then you can discount them back and calculate the present value of future cash flows. And this is going to be your valuation. So this is how it's done, right? So now we are at the stage that we have understood the business model, and now we are starting with the projections. But before you can get into the projections, you need to analyze what is their revenue, right? So then we will be able to project it. So what are the drivers of this revenue? So you could take a bottom up approach or a top down approach, right? So bottom up approach would mean number of stores. Let's say you're talking about a retail company, so number of stores, and then average sales per store or something like that, right? Or you could take a top down approach, that okay, what is World Bank saying about this industry in other countries similar to the country that I'm talking about. So let's say maybe I'm talking about a country like Indonesia, right? And I want to see what's happened in peer countries like Vietnam or South Korea or Japan or China or Malaysia, right, or Singapore. So what I'll see is okay, which countries are kind of similar to the one that I'm looking at, and I'll see how much of that particular product has sales volumes in that country. And then I can try and say, okay, my country, the one I'm interested in right now, let's say I'm talking about Indonesia, so this is going to be probably the sales per person, or in terms of as a percentage of GDP, or some metric I can take and do a top down approach. Or bottom down approach is I can just say, okay, this is my company, this is the number of stores they have, and this is the average sales per store, and this is what they are saying that we are going to increase in future. So that could be an approach. Or you could just use a blend of both, that you could say, okay, what is the GDP growth rate of Indonesia based on what IMF data mapper is saying, and then what is the market size in other countries as a percentage of GDP. So that's what Indonesia should also get to, right? And then what will be the market share of the company that you are doing your research on. And then you can combine that with, okay, how many stores are they planning to open, and does that match with what you are thinking in terms of the top down. So this is your revenue analysis. Now moving to pricing power, and my personal favorite is pricing power. I'll tell you, this is so important. The other day I was just sitting with some of my relatives, and they were asking me which company should we invest in. And I said, we are living in an inflationary environment. So costs are going up, right? Which puts up pressure on the company's margins. And we are not just interested in revenues, right? I mean, the valuation that you will develop for a company comes from its cash flows, right? And cash flows will be there after subtracting the costs, right? And whatever investment is required in the increasing business. So it's not the revenues that directly go to the cash flows. There's so many things in the middle. So what we really are interested in is margins. And in an inflationary environment, if your costs are going up, well, you have to be able to increase your price. But then it depends, do you really have that pricing power? And think about it, right? I mean, if you compare Huawei with Apple, now they're both making and selling smartphones, but then Apple has a different type of customer base, and then Huawei is competing with companies like Redmi and Xiaomi and I don't even know, right? So the point is that it's a completely different market within the same market of smartphones, it's a completely different type of pricing power that Apple has and that Huawei has. So as an investor, or even before as an investor, as a analyst, what you need to understand is that the revenue analysis that you're doing, that is very directly linked to the pricing power that a industry and a company has. So this is extremely important, and it is linked to the company's competitive positioning in the market, right? Obviously, Apple has a lot more pricing power, I believe, than Huawei and Redmi and Xiaomi. Okay. So again, I mean, firms selling nearly identical products. So, I mean, Huawei, Redmi, Xiaomi, I wouldn't say they are identical, but I mean, they are nearly identical, right? Very different from Apple because Apple has a different operating system. So then, of course, Apple has a higher pricing power. So this is the high level introduction to pricing power. Of course, there's a lot more to it, but at your current stage, what you need to understand is that the more homogeneous your product, the lower your pricing power. The more differentiated your product, the higher your pricing power. Also, in some industries, this is related to barriers to entry. So things like oil, right? And companies like Aramco and ADNOC, which are, of course, your main players in the OPEC, right? So even though oil, there is no differentiation. Oil is oil. But it's the barriers to entry that changes the game over here. So it's not easy for somebody to come in and become an oil exploration company. So they have a lot more pricing power as well. And usually what you see is they do reduce the quantity that they are producing and the price goes up. And if you've already covered your economics material, you know that how important increasing the price is. So if they are manufacturing where MC is equal to MR in terms of the quantity, right? But in terms of the price, they are pricing it at where the demand curve is. So this difference between the cost and the price is what is their economic profit. And as an investor, that's what we want, right? We want positive economic profit because that means the company is able to earn more than what it deserves to earn in terms of its cost, which includes cost of capital. So they are able to earn a return higher than the risk that is there in the business. So, I mean, of course, this ties in with the economics material, but what I'm trying to tell you is that pricing power is very important when it comes to identifying companies that can generate good returns for your investors. Okay, and firms operating in less competitive markets, again, perfect competition or monopolistic competition to some extent has less pricing power. So I would say Huawei is monopolistic competition, right? Oligopoly and monopoly have significantly more pricing power, right? So now, perfect competition, there is no pricing power at all. Monopolistic competition, there is some pricing power because of your differentiation, but it's not really there unless you're Apple within that. Or maybe you try to become something like Samsung and you keep coming up with new innovations like the Z Flip and this flip and that flip. But the point is that there will always be a lot of pressure on you from the other players within that market space because it's having lower barriers to entry. So new firms can enter and increase the output and they will put a downward pressure on your price. Oligopoly and monopoly, there's high barriers to entry, right? So it's not easy for new firms to come in and push down your prices. And you can keep high prices and you can keep having sustainable positive economic profits. And that is what we would like as analysts to identify and develop a research report on and recommend to our investors. Yeah, so that's your very important economics material coming together with this equity analysis. Rising profitability over time is an important indicator of pricing power because it demonstrates that competitors, new entrants, or substitutes are not driving your fast prices down, right? And Apple, I think, is a very good example. They've been able to maintain their differentiation because their hardware and software is the same. So from a security perspective, they have a proposition to the customer which the other players don't have that way, right? All right, I think let's take a break here. We'll come back and then we'll get into, now that the sales part is done and the price part is done, now we're going to get into the cost, and this is the manufacturing and production cost, whether it's for a good or sale, and then that brings you to your gross profit, and then selling, general, and administrative expenses. Selling, general, and admin expenses, then that brings you to your operating profit, which is your earnings before income and tax, right? And some part of the cost of goods sold and SG&A is fixed, such as, let's say, the rent of your office or rent of your factory, and some part of this is going to be variable, which is like your raw material for your product or your selling commissions. So we'll look at those dynamics as well, and that's going to be an interesting discussion. But we will do that after a short break. So please take a break, get fresh, and then come back and let's jump into this.